Have you ever wondered why some countries bounce back from economic disasters while others spiral into chaos? It's not about luck. It's not even about having more money to start with. Here's what nobody tells you. The difference comes down to something most people never think about: the invisible architecture that either catches you when you fall or lets you crash straight through. Here at Simple Money, we've spent years studying how financial systems actually work during crises. And today, I'm going to reveal why understanding this could be the difference between surviving the next economic shock and losing everything you've built. By the end of this, you'll see why 2008 didn't have to be as bad as it was. And more importantly, you'll understand what to watch for when the next crisis hits. Here's what's really happening. Most people think economic shocks are like natural disasters. They just happen. Lightning strikes, an earthquake hits, and we all suffer the consequences equally. But that's completely wrong. Economic shocks are more like testing a building's foundation. The earthquake doesn't destroy the building. The weak foundation does. And here's the uncomfortable truth. Some financial systems are built on concrete and steel. Others are built on sand and hope. When 2008 hit, Iceland's entire banking system collapsed in a week. Their three largest banks failed simultaneously. The country went bankrupt. People lost their life savings overnight. But look at Canada during the same crisis. Not a single major Canadian bank failed. Not one. Same global shock, completely different outcome. The difference wasn't the size of the earthquake. It was the foundation underneath. Think about your own life for a second. When your car breaks down unexpectedly, what happens? If you have an emergency fund, it's annoying but manageable. If you're living paycheck to paycheck, it's a catastrophe that spirals into more debt. Financial systems work exactly the same way. The shock isn't what matters most. It's whether the system has shock absorbers built in. And here's what makes this so critical right now. We're not talking about ancient history. We're talking about patterns that repeat over and over. The dot-com bubble, the 2008 crisis, the COVID pandemic. Each one revealed which systems were ready and which were disasters waiting to happen. The next shock is coming. It always does. The only question is whether you'll be in a system that protects you or one that amplifies the damage. Let me show you exactly how this works. The first way financial systems respond to shocks is what I call the circuit breaker effect. Here's what this means. When something goes wrong in your electrical system at home, the circuit breaker trips. It cuts the power before the wires melt and your house burns down. It's designed to fail safely. Smart financial systems have the same thing built in. Automatic mechanisms that kick in when things start going sideways. During the 2008 crisis, the Federal Reserve dropped interest rates to basically zero within months. They didn't wait for Congress to debate. They didn't form a committee to study the problem. They flipped the switch immediately. This matters more than most people realize. When credit freezes up during a crisis, businesses can't make payroll. They start laying people off. Those people stop spending. More businesses fail. It's a death spiral. But when the central bank cuts rates fast, it keeps some money flowing. It's not perfect. It doesn't solve everything, but it stops the immediate bleeding. Now here's where most countries fail. They don't have automatic circuit breakers. They have to get approval from politicians who are more worried about looking tough than preventing disaster. Think about a country where the central bank can't act independently. The economy starts tanking, but the government is in gridlock. They argue for months about what to do. By the time they decide, thousands of businesses have already closed. Millions of people have lost their jobs. The damage isn't from the initial shock. It's from the delay in response. Here's the psychology behind why this matters. During a crisis, fear spreads faster than facts. People panic. They pull their money out of banks. They stop spending entirely. They hoard cash under mattresses. This panic actually creates more damage than the original problem. It's a self-fulfilling prophecy. Everyone expects disaster, so they act in ways that guarantee disaster happens. Circuit breakers interrupt that panic spiral. They signal that someone's in control, that there's a plan, that the system isn't going to just collapse. It's like when a pilot's voice comes over the intercom during turbulence. The turbulence doesn't actually stop, but hearing that calm, controlled voice makes passengers relax. They stop panicking. And that actually helps, because panicked people make bad decisions. The second response mechanism is what I call the firewall system. Imagine you're in an apartment building. A fire starts in one unit. If the building has proper firewalls, the fire stays contained. It's terrible for that one apartment, but the whole building doesn't burn down. Without firewalls, one small problem becomes a total catastrophe. This is exactly what happened with the 2008 mortgage crisis. The problem started with subprime mortgages, risky loans to people who couldn't really afford them. That should have been a contained problem affecting one part of the financial system. But there were no firewalls. These bad mortgages got bundled into securities. Those securities got sold to banks everywhere. Those banks used them as collateral for other loans. Everything was connected to everything else. So when the mortgages started failing, it didn't just hurt mortgage companies. It destroyed investment banks, insurance companies, pension funds, banks in countries that had never even issued a subprime mortgage. One fire became a global inferno because there were no walls stopping the spread. Now look at how some countries had built-in firewalls. Canada requires much higher down payments for mortgages. Their banks can't take as many risks. They can't bundle mortgages the same way American banks did. This made Canadian banking boring. Less exciting? Lower profits in good times. But when 2008 hit, those boring regulations were firewalls. The problems in the US housing market couldn't spread into the Canadian system the same way. The fire stayed on the other side of the wall. Here's what's fascinating about human psychology. In good times, everyone hates firewalls. They seem like unnecessary restrictions, like wearing a seatbelt on a sunny day when you're just driving to the grocery store. Banks complain that regulations hurt their competitiveness. Politicians campaign on cutting red tape. Everyone wants maximum freedom and minimum restrictions. Then the crash comes. And suddenly everyone's screaming about why there weren't more protections in place. It's the same pattern in personal finance. When times are good, people don't want to waste money on insurance or emergency funds. That's money that could be spent on something fun right now. Then the emergency hits. The medical bill arrives. The job disappears. And suddenly that boring insurance policy is the only thing standing between you and financial ruin. Firewalls feel like a waste right up until the moment you desperately need them. The third mechanism is what I call the pressure release valve. Think about a pressure cooker. As heat builds up inside, pressure increases. If there's no way to release that pressure safely, the whole thing explodes. That's why pressure cookers have that little valve on top. It lets steam escape gradually instead of building to a catastrophic failure. Financial systems need the same thing. A way to release pressure before it explodes. Here's how this shows up in real life. During the COVID pandemic, millions of people couldn't work. Businesses shut down overnight. In a normal situation, this would mean instant mass foreclosures and evictions. Millions of people losing their homes simultaneously. That would have been catastrophic, not just for those families, but for the entire economy. Mass foreclosures, tank housing prices, that destroys household wealth, that kills consumer spending. That leads to more business failures, another death spiral. So what did many governments do? They implemented eviction moratoriums, payment holidays on mortgages, expanded unemployment benefits, student loan payment pauses. These were pressure release valves. They let people stay in their homes, keep food on the table, survive until the crisis passed. The pressure got released gradually, instead of all at once. Now here's what makes this controversial. Some people see these programs as rewarding irresponsibility, bailing out people who should have been better prepared, creating moral hazard. And look, there's a legitimate debate there. But here's what those critics miss. During a systemic crisis, individual responsibility doesn't matter anymore. If one person can't pay their mortgage, that's their problem. If 10 million people can't pay their mortgages simultaneously, that's everyone's problem. The entire financial system is at risk. It's like being on a boat that's sinking. You can argue all you want about whose fault it is that we hit the iceberg, but right now, everyone needs to start bailing water or we all drown together. The psychology here is crucial. People need hope to keep functioning. If you tell someone they're going to lose their home no matter what, they stop trying. They stop making any payments. They stop maintaining the property. They give up entirely. But if you give them a path forward, even a difficult one, most people will take it. They'll work with the system. They'll do payment plans. They'll find new jobs and catch up eventually. The pressure release valve isn't about letting people off the hook. It's about preventing a pressure explosion that destroys everything. The fourth response is what I call the emergency transfusion. When someone's bleeding out from a major injury, you don't lecture them about eating healthier. You don't tell them they should have been more careful. You give them a blood transfusion immediately, or they die. Financial systems sometimes need the same thing, an emergency injection of liquidity to keep everything flowing. This is what central banks do when they say they're providing liquidity to the market. They're essentially giving the financial system a transfusion, pumping money in to replace what's hemorrhaging out. During 2008, the Federal Reserve didn't just cut interest rates. They created entirely new programs to inject money directly into specific parts of the financial system that were seizing up. Money market funds were collapsing. The Fed created a program to support them. Commercial paper markets froze. The Fed stepped in to buy commercial paper directly. Credit markets were paralyzed. The Fed opened emergency lending facilities. None of this was normal central bank activity. These were emergency trauma room procedures to keep the patient alive. Here's what most people don't understand about this. When the Fed creates money during a crisis, it's not printing free money out of thin air for fun. It's replacing money that's disappearing. During a crisis, money actually vanishes from the economy. Not physically, but functionally. When banks stop lending, that's money disappearing. When people hoard cash instead of spending, that's money disappearing from circulation. When asset prices collapse, that's wealth vanishing. If the central bank doesn't replace some of that disappearing money, you get deflation. And deflation during a crisis is absolutely catastrophic. It means your debts stay the same, but your income drops. Your house is worth less, but you still owe the full mortgage. Everything gets worse and worse in a deflationary spiral. The emergency transfusion isn't about making everyone rich. It's about preventing that deflationary death spiral. Now here's the psychological trap. After the crisis passes, people look back and say the emergency measures were unnecessary. The system didn't completely collapse, so clearly we didn't need all that intervention. This is like saying seatbelts are useless because you survived the car crash. You survived because of the seatbelt, not despite it. When emergency transfusions work, they make themselves look unnecessary in hindsight. The catastrophe that was prevented never happens, so people assume it was never really going to happen. This is why we keep making the same mistakes. We forget how bad things almost got. We dismantle the emergency systems. Then the next crisis hits, and we're shocked that we're not prepared. The fifth mechanism is what I call the credibility shield. Here's something that sounds abstract, but is absolutely crucial. During a crisis, belief matters as much as reality, maybe more. If people believe the government and central bank have the situation under control, they stay relatively calm. They keep their money in banks, they keep spending at somewhat normal levels. The crisis stays contained. But if people lose faith in the authorities, panic takes over. Bank runs, hoarding, economic paralysis. The loss of credibility turns a manageable crisis into a catastrophe. This is what happened in Argentina over and over. The government would face a crisis. They'd promise to fix it. People wouldn't believe them because of past broken promises. So people would pull money out of banks and convert it to dollars. This would make the crisis worse. The government would break their promises again, and the cycle of distrust would deepen. Contrast this with how people reacted to Paul Volcker in the 1980 seconds. He was the Federal Reserve chairman who broke the back of inflation. It was incredibly painful. Interest rates went to 20%. The economy went into recession. Millions lost their jobs. But Volcker had credibility. People believed he would do what he said. That belief allowed his policies to work. If people hadn't trusted him, they would have kept expecting inflation. That expectation would have caused more inflation. The policy would have failed. The credibility shield isn't about spin or public relations. It's built over years of consistent, predictable behavior, of doing what you said you'd do, of being transparent about trade-offs. Think about this in your personal life. If you have a friend who always comes through in emergencies, you stay calm when problems arise. You know they'll help. You don't panic. But if you have a friend who always promises help and never delivers, you panic the moment anything goes wrong. You can't count on them. So you're on your own from the start. Financial systems work the same way. The credibility built up during normal times becomes the shield that protects you during crises. Here's what makes this so difficult. Building credibility takes years. Destroying it takes minutes. One broken promise, one obvious lie, one moment where the authorities clearly don't know what they're doing, and the shield shatters. This is why central bank independence matters so much. If people think the central bank is just doing whatever politicians want, they don't trust it. They assume decisions are being made for political reasons, not economic ones. But if the central bank has a track record of making unpopular but correct decisions, people trust it. That trust is the shield that keeps panic from spreading during the next crisis. Let me tell you about Marcus and Jennifer. They both got hit by the same economic shock, the COVID pandemic. Both lost their jobs in March 2020. Both had about the same amount of savings, but what happened next was completely different. Marcus panicked immediately. He pulled all his money out of his investment accounts, sold everything at the bottom of the market, converted everything to cash. He stopped paying his credit cards because he figured he'd just go bankrupt anyway. He gave up looking for work because everything seemed hopeless. Within 6 months, Marcus was broke. His credit was destroyed. He'd missed so many payments that catching up seemed impossible. The economic shock had completely devastated him. But here's what Marcus didn't realize. He was living in a country with strong financial shock absorbers. There were unemployment benefits available, payment deferrals on his student loans, eviction protections, programs to help people in exactly his situation. Marcus never used any of them because he didn't believe they'd work. He didn't trust the system, so he acted like there was no system at all, and that belief became self-fulfilling. Now look at Jennifer. She got hit by the exact same shock at the exact same time, also lost her job, also scared. But Jennifer understood something Marcus didn't. She knew the financial system had response mechanisms, so instead of panicking, she took action within the system. She immediately filed for unemployment. She called her mortgage company and got approved for a payment deferral. She called her credit card companies and got enrolled in hardship programs. She kept her money invested because she understood that the Fed was flooding the market with liquidity. She looked for work, but she wasn't desperate. She could wait for a decent opportunity instead of taking the first terrible job offer. She used the time to learn new skills, to position herself for when things recovered. By the time the economy started reopening, Jennifer was in better shape than before the crisis. Her investments had recovered and then some. Her skills were upgraded. She got a better job than the one she'd lost. The crisis actually became an opportunity because she understood how the system worked. Same shock, same starting point, completely different outcomes. The difference wasn't intelligence. It wasn't luck. It wasn't even having more money. It was understanding that financial systems have shock absorbers and knowing how to use them. Here's what most people miss about economic crises. They're not divine punishment. They're not random chaos. They're system failures with predictable patterns and established response mechanisms. The people who survive and thrive aren't the ones who panic or pretend everything's fine. They're the ones who understand the system and work within it strategically. Think about what this means for you. The next economic shock is coming. It always does. Maybe it's a recession. Maybe it's a market crash. Maybe it's something we haven't even imagined yet. When it hits, you'll have two choices. You can be like Marcus, panic, act like there's no system, make decisions based on fear, and probably make everything worse for yourself. Or you can be like Jennifer, understand the shock absorbers, use the response mechanisms, stay calm enough to think strategically, and potentially come out stronger on the other side. The circuit breakers will activate, interest rates will be cut, emergency programs will be created, firewalls will contain the damage, pressure valves will prevent explosion. The credibility of institutions will matter enormously. All of this will happen whether you understand it or not. But understanding it gives you a massive advantage. You'll know what to watch for, what resources are available, how to position yourself. Most importantly, you'll know that the shock itself isn't what determines your outcome. It's how you respond within the system that matters. Here's the uncomfortable truth nobody wants to say out loud. Some people actually benefit from economic shocks, not because they're evil or lucky, but because they understand the patterns and position themselves accordingly. When everyone else is panicking and selling, they're calmly buying assets at discount prices. When everyone else is paralyzed by fear, they're taking advantage of emergency programs. When everyone else thinks the world is ending, they're seeing opportunity. This isn't about being callous or predatory. It's about understanding that economic shocks are part of how the system works. They're not aberrations. They're features, not bugs. And the financial system's response to these shocks is also not random. It follows patterns. Those patterns create opportunities for people who understand them. Think about real estate after 2008. People who understood that the Fed would eventually flood the system with liquidity bought properties at historic lows. They knew prices would recover once the emergency transfusion kicked in. They were right. Those investments made fortunes. Or look at the stock market in March 2020. It crashed by a third in a few weeks. People who understood that the Fed and government would do whatever it took to stabilize things bought aggressively. Within months, the market hit all-time highs. Those who panicked and sold locked in massive losses. The difference wasn't insider information. It was understanding how financial systems respond to shocks, having a mental model of what central banks would do, knowing that emergency mechanisms would activate, trusting the system enough to act strategically instead of emotionally. This doesn't mean being reckless. It doesn't mean ignoring real risks. But it does mean understanding that the system is designed to survive shocks, and that design creates predictable patterns you can use to your advantage. So here's what you need to remember. The circuit breaker effect means automatic stabilizers activate fast. The firewall system contains damage and prevents contagion. The pressure release valve prevents catastrophic explosion. The emergency transfusion replaces disappearing liquidity. The credibility shield maintains trust that allows everything else to work. These aren't just theoretical concepts. They're the actual mechanisms that determine whether you survive the next crisis or get destroyed by it, whether you emerge stronger or broken, whether the shock becomes an opportunity or a catastrophe. The financial system will respond to the next shock. That's guaranteed. The only question is whether you'll understand that response well enough to protect yourself and potentially profit from it, or whether you'll panic like Marcus and make everything worse. The choice is entirely yours, but only if you understand the system well enough to make that choice consciously instead of reactively. What will you do differently when the next shock hits?